Financial power is sold to young people as a ladder. Work harder, think faster, climb higher. But that is not what the machine really builds. It builds something colder, something quieter, something that asks for payment long before it offers status. And the most dangerous part? The payment does not look like sacrifice at first. It looks like professionalism. In Geneva, 4 people sit in a room with no agenda on the table and no presentation on the screen. A 71-year-old man speaks for roughly 6 minutes. Then he stops, and the room moves. Somewhere else, a 23-year-old analyst opens a terminal for the first time. Those two scenes look like distance. They are not. They are a transaction separated by 47 years. So this is the real question. What did the machine actually buy from him? Not just his labor, not just his intelligence. Those are cheap by comparison. What it bought was far more valuable. Silence, proximity, confidence, access, political alignment, long horizon thinking, and finally, the ability to stop feeling friction when consequences spread too far to touch. 7 prices. Pay them all, and the room moves when you speak. The first price is silence. Not cowardice, not incompetence, silence with composure. Silence that protects hierarchy. Silence that keeps the surface smooth while the machinery underneath keeps turning. That lesson arrives early, before money gets large, before titles sound impressive, before you even understand what you are becoming. It arrives when the coffee is lukewarm, the floor is still half empty, and the market has not opened yet. You are 23. You have $88,000 in debt. You have been at the desk since 5:45 a.m., 3 monitors, 1 coffee, a stack of pitch decks no one senior wants to touch. The salary sounded enormous until you saw what your managing director built in a single day. So you compress yourself, read a 10K in 40 minutes, format faster, speak less. Survival is not noble here. It is a deliverable. Then one morning, hidden inside a senior associate's model, you find an error worth $2 million. You stare at it, your pulse tightens, your jaw locks. You correct it quietly in your own file, and you say nothing. Why? Because the machine teaches its first hard truth before it teaches prestige. It does not reward honesty in the abstract. It rewards controlled discretion inside a hierarchy. That difference will follow you for decades. A few months later, you process a $430 million deal from a spreadsheet on the 31st floor. You never meet the client, you never see the boardroom, but your numbers sit in that room in your place. That is the first bargain of elite finance. Proximity to consequence without visible ownership of it. You are close enough to matter, invisible enough to deny that you matter, and the machine prefers you that way. The second price is proximity. Not title, not money, proximity. 2 years later, you are finally in the room. Though not the main room, the side room, the waiting room, the room just outside authority. But now you are no longer formatting reality. You are structuring it. You draft terms on a $180 million mezzanine financing. A CFO looks across the table. For the first time, your preparation has a face on the other side. You explain a covenant breach scenario without flinching because you've run it 40 times in the past week. That is how preparation mutates into authority. Then comes the leveraged buyout of a regional logistics company. You model EBITDA margins, you model debt service coverage, you present it cleanly, and you do not model the human cost in Ohio. Nobody asks you to. That omission is not accidental. It is part of the architecture. Here's the twist most people miss. The machine is not primarily rewarding intelligence yet. It is rewarding your ability to remove friction between capital and outcome. Human friction, moral friction, emotional friction. Once the missing people are outside the spreadsheet starts to feel complete. That is how intelligent people begin calling a partial picture the whole picture. And that is only the second price. Then you build your first internal network, a vice president who brings you into deals, an associate who feeds you information before anyone else has it. You protect each other, not out of friendship, but out of mutual utility. Soon you manage 4 analysts and 2 associates. You stop counting your own hours because hours belong to labor. Deal flow belongs to operators. Once your mind reorganizes around deal flow, identity begins to reorganize with it. The third price is confidence. Not confidence as emotion, confidence as product. You close your first transaction independently, a $620 million acquisition financing for European infrastructure in Southeast Asia. Your managing director is on the cover sheet. You are on page 6. But when the numbers get complicated, the client turns to you. That glance matters more than the title, because now execution is attached to your face, not just your file. Then the moral terms harden. A target company's pension obligations are restructured after close because the acquiring fund needs a 22% IRR. You know what that means for retirees. Nobody says it in the meeting. Nobody needs to. Silence now is no longer uncertainty. It is alignment. The deal closes in 11 weeks. Your year-end cut is $480,000. You wire $40,000 to your parents. Suddenly, conscience has competition. You buy a 2-bedroom apartment in a city where 2 bedrooms signal arrival more loudly than taste ever could. You tell yourself the pension situation was already insolvent. You may even be right. But notice what changed. You no longer ask if the deal is good, you ask if the deal is executable. That sounds like technical maturity. It is something bigger than that. It is the moment moral discomfort gets refinanced into professional language. The fourth price is informational leverage. You are sourcing now, not just executing. Clients call you directly. Private equity shops route deal flow through you. 3 closings in 4 years. No missed deadlines. No leaked information. That reliability is worth more than raw intelligence. You manage a $1.2 billion book of advisory mandates. Your associate runs the model. Your vice president coordinates diligence. You sell the vision. You sell certainty. And then you discover a sharper form of leverage. The knowing. Which company is about to launch a strategic review before the announcement? Which sovereign fund is quietly building a position before disclosure? You do not trade on it. That is not the point. The point is posture. Knowing changes how fast you move, how calmly you speak, how decisively you frame options. Information does not merely inform power, it alters presence. But merit still has a ceiling. You lose a $2.8 billion mandate not because of the numbers, but because a competing managing director belongs to the same private club as the chairman. That is not cartoon corruption. It is more elegant than that. It is access behaving like destiny. You do not protest. You join 2 clubs within the month. Because by now the lesson is complete. Numbers win arguments, but relationships decide which arguments enter the room. Soon you manage 12 client relationships, each worth between $3 million and $40 million in annual fee revenue. At that point, you are no longer working for the bank in the ordinary sense. You are the bank's relationship with those clients. Institutions look massive from outside. Inside, they often compress into a handful of trusted human conduits. Become one of those conduits and your judgment stops feeling private. It becomes revenue infrastructure. The fifth price is alignment. You sit on an internal credit committee. A deteriorating balance sheet sits beside a request for $900 million in revolving credit. You vote yes, not because the credit is clean, because losing the relationship would cost 3 times the exposure. That single sentence explains elite finance more honestly than most ethics panels ever will. At this level, many financial decisions are political decisions wearing financial clothing. Then the geography expands. Singapore, Zurich, Abu Dhabi, Dubai. Dinners with ministers, not politicians, because formality matters at this altitude. These are not decorative meals. They are maintenance on the circuitry of trust. Capital does not move toward returns alone. It moves toward regulatory familiarity, political alignment, and the comfort of the right people dealing with the right people in the right room. The relationship is not beside the business, it is the business. The sixth price is time horizon. There are 14 partners in the division. You are one of them now. You carry interest in the fund, skin in every major deal. This changes the shape of thought itself. Annual bonuses start to look provincial. Quarters become noise. You stop optimizing for this year. You optimize for the 5-year fund cycle, then for decades. That is another hidden privilege of power. Distance from immediate judgment. That longer horizon shows up in scale. You lead a $4.3 billion acquisition of a European energy infrastructure company. 3 months of negotiation. 4 regulatory jurisdictions, 2 competing bids. Your consortium includes your fund, a Middle Eastern sovereign co-investor, and a Canadian pension. That is what true scale feels like. Not simply more zeros, more coordination, more invisible diplomacy. More rooms where language becomes careful because one careless phrase can move billions. The closing structure runs through a Luxembourg SICAR feeding into a Cayman feeder fund. Tax efficient, entirely legal, vetted by attorneys in Dublin and Singapore. You sign without hesitation because hesitation is not what this layer pays for. The structure adds 180 basis points to the fund's net IRR. Your carried interest from this transaction alone will compound to more than $40 million. Outsiders call that greed. The machine calls it precision. The seventh price is abstraction. Your social world narrows to people who control capital. Then two calls arrive in one day. A Gulf sovereign wealth fund with $7 billion seeking deployment and considering your firm for an anchor mandate. A finance minister calling directly. Same room, same hour, no Bloomberg glow, no trading floor noise, just glass, silence, and a phone connected to decisions large enough to bend entire asset classes. At that altitude, you are not simply in the market anymore. The market is partly in you. When you buy, others watch. When you pull back, analysts write for weeks. You sit on 3 corporate boards. You advise a multilateral development bank's infrastructure program. You brief government twice a year on capital market conditions. Officially, you advise. In practice, the distinction between advice and influence starts getting harder to feel from the inside. This is where morality changes shape, not because everyone becomes theatrical villains, but because consequence becomes too diffuse to touch. You do not feel the layoffs downstream. You feel the fund return. So you optimize the fund return. There is no outside perspective anymore. You are the perspective. Senior advisor, chairman emeritus, family office principal. All technically accurate. None of them capture the truth of a man with stakes in 5 funds, 2 private banks, and a Bermuda reinsurance vehicle. You are 71 years old, 47 years inside the machine. 3 central bank governors know you by your first name. Not because you control monetary policy, but because information flows in both directions. Your committee deploys across sovereign debt, infrastructure, equity, distressed credit, and currency carry structures in 14 markets. Assets under management sit above $90 billion. The exact number is known to 4 people. You are one of them. And now comes the coldest part. You no longer think in terms of trading. Trading reacts. Positioning proceeds. 2 years before anyone else sees a currency block facing liquidity stress, you structure accordingly. When the event arrives, your funds gain, and the press calls it prescient risk management. They do not see the cost. The people you trust now number fewer than 10. Beyond that circle, almost nothing. Access expanded, human life narrowed. The system would cost more to dismantle than to keep. That is not ordinary power. It is something quieter, colder, and more permanent than power. Which brings us back to Geneva. 4 people, no agenda, no presentation. A 6-minute remark and the room moves. Most people call that influence, but influence is too soft a word. What moved that room was 47 years of friction removed from one man's voice. Somewhere else, a 23-year-old analyst opens a terminal for the first time. He thinks the system rewards effort, then intelligence, then loyalty. He is wrong, but not in the way he expects. The system rewards whatever reduces friction for capital. That is the real bargain. And in the next script, the harder question begins. If the price is this high, why do smart people still volunteer to pay it?